Everyone's staring at price charts right now, waiting for Bitcoin to break out or some altcoins to moon. But the biggest signal this week didn't come from a chart, it came from the SEC. In a quiet move, they just told institutions it's finally legal to stake crypto. No lawsuit risk, no gray area. Ethereum, Solana, and every proof of stake chain just got a major boost, and retail hasn't even noticed. My name is Danielo, and today we're covering three things: what exactly the SEC said about staking, how the new Clarity Act could reshape US crypto regulation, and why institutions are already positioning themselves for a major shift while everyone else is still waiting for candles. If that sounds interesting to you, make sure to hit that subscribe button and ring notification bell so you never miss future crypto updates. Alright, let's get into it. Let's start with what actually happened. On May 29th, the SEC quietly released a letter. In it, they make a crucial statement that certain staking models, when structured correctly, quote, would not involve an offer of securities. That's the kind of phrase that matters. It's the SEC's way of signaling that this isn't some gray area workaround. It's something that can exist within the legal framework. To be clear, this doesn't mean every staking model is now in the clear. What it means is that under the right structure, like custodial staking where firms stake customer assets on their behalf, the SEC won't treat it as a securities offering. That opens the door for traditional custodians, asset managers, and even banks to start offering staking yield directly to clients without fear of being sued. Ethereum, Solana, Avalanche, any proof of stake chain with demand just became a lot more attractive to institutional capital. This is one of those moments where retail investors might just shrug, but smart money is already positioning. When you see language like, quote, not an offer of securities from the SEC, that's a legal green light. And when legal risk disappears, new capital begins to flood in. So, what does this actually unlock? The most immediate shift is that it clears the path for staking-based ETFs. We already have Bitcoin ETFs live, and ETH spot ETFs just approved. But staking has always been the missing piece, because if you're a fund holding ETH and you can't stake it, you're leaving 3 to 5% on the table in passive yield. Up until now, most ETF issuers avoided staking due to legal uncertainty and the fear of triggering securities rules. That's why none of the approved ETH ETFs include yield. But now, with the SEC clarifying that certain staking services don't count as securities offerings, that door just cracked open. Bloomberg analysts are already predicting the first ETH staking ETFs could be approved as soon as this summer. Firms like Franklin Templeton, ARK, and Hashdex are rumored to be exploring staking exposure through custodians. And don't forget Grayscale. They've already pushed for more flexible ETH products in the past, and they'll almost certainly re-engage now that staking clarity is on the table. If these go through, TradFi clients, pensions, family offices, even hedge funds could start earning real on-chain yield without ever touching DeFi themselves. That changes the risk-reward equation for Ethereum completely. Instead of being just a speculative asset, ETH becomes a productive, yield-generating investment that fits into institutional portfolios. And this isn't just about Ethereum. Once the staking ETF model is proven, it sets the precedent for Solana, Avalanche, and any other network with demand from capital allocators. We're not talking about short-term hype. We're talking about new rails for serious money to flow into proof-of-stake networks and earn while doing it. While the SEC's staking comments were already a big win, they didn't happen in isolation. Just one day later, US lawmakers introduced something called the Clarity Act, a bipartisan bill aimed at creating clear legal definitions for digital assets. This wasn't just headline bait. It's a real policy proposal from Representatives French Hill, Dusty Johnson, and Wiley Nickel, spanning both sides of the aisle. That kind of cooperation is quite rare, and it shows that crypto is becoming a politically important issue. The bill does three things that actually matter. First, it draws a much-needed line between commodities and securities, pushing most crypto tokens under the CFTC's oversight rather than the SEC's. That instantly reduces regulatory risk across the entire board. Second, it sets up disclosure rules and consumer protections that could make it easier for compliant projects to launch and operate inside the United States. And third, it gives both centralized and decentralized platforms a path towards legal registration, something that's been missing for years. This isn't just good for protocols, it's good for investors too. If passed, the Clarity Act would make it easier to know which assets are safe to hold, which platforms are legally protected, and where capital is flowing. You can't onboard institutional money without rules, and this bill is a step toward building those rails without suffocating innovation. The timing here isn't random. The SEC's new tone and the Clarity Act landing within 24 hours of each other send a clear message. Policymakers are getting pressure from voters, donors, and the market to stop kneecapping crypto and start creating structure. That structure doesn't kill opportunity, it accelerates it. Now, before you assume this means every staking protocol is in the clear, here's the catch. Liquid staking is still a gray area. The SEC's later only addressed custodial staking, where an institution stakes assets on a customer's behalf and returns the rewards. It didn't cover liquid staking protocols like Lido or Jito, where you deposit ETH or SOL and receive a tradable token like ST-ETH or Jito SOL in return. Those models introduce liquidity, but they also blur the line between staking and yield-bearing derivatives, and that's exactly where regulators start to hesitate. While the SEC hasn't explicitly gone after LSTs yet, they've made it clear in the past that wrapping yield into a tradable asset could raise securities concerns. So, even though custodial staking just got the green light, liquid staking tokens still live in regulatory limbo. This doesn't mean you should avoid them, but it does mean you should watch for signals. If ETFs are allowed to stake but not hold LSTs, that's a strong clue regulators are drawing a line there. And if you're using LSTs in DeFi or as collateral, that adds a second layer of risk most people aren't thinking about. It's not bearish, it's just reality. Clarity around staking is coming in pieces, and LSTs are still under review. Let's talk about how smart money is already responding to all of this, because while retail waits for chart patterns and confirmations, institutional players move when legal clarity appears, not when price does. Since the SEC's letters dropped, we've seen ETH accumulation by whale wallets quietly increase, with large transfers moving into custodial addresses on Coinbase and Anchorage. You can spot this using tools like Arkham or Nansen. Just look for multi-million-dollar wallet inflows that track with policy announcements and not headlines. Coinbase has already hinted at expanding staking offerings for institutional clients, and fund managers are adjusting ETF filings to prepare for yield-bearing versions, even before the approvals go live. But here's what's wild. Ethereum is still trading around 2,500. No breakout, no hype, no rotation yet, which means the money moving right now isn't chasing price. It's positioning for when that clarity turns into capital flows. And that positioning includes not just ETH, but any asset that benefits from compliant staking access. Sol, AVAX, maybe even Atom or Near if their ecosystems mature in time. The same pattern is repeating. Regulation shifts, infrastructure adapts, and capital rotates in. Retail tends to wait for the third step, but the asymmetric upside is almost always in the second, when the market structure is changing, but there's no one talking about it yet. Watch the wallets, follow the filings, and pay attention to what moves before the headlines start catching up. Let's zoom out. The biggest shift we've seen in crypto this year hasn't come from price or product. It's come from politics. With President Trump back in office, the tone around crypto in Washington has flipped. This administration isn't just tolerating crypto, it's actively signaling support. Trump's team has already embraced crypto donors, hosted blockchain industry roundtables, and is pushing agencies to stop the overreach we saw in the last cycle. That shift is starting to ripple across regulators. The SEC under Gensler, once the face of enforcement, is suddenly softening its tone. Not because of some ideological turnaround, but because political pressure is mounting. Anti-crypto policy doesn't win votes anymore as voters are more informed. Lobbying is more organized, and the narrative has changed from, quote, is crypto legit, to, quote, how does the US compete? You can already see it in Congress. The Clarity Act has bipartisan momentum. Lawmakers across the aisle are realizing that crypto builders and investors aren't fringe anymore. They're voters, donors, and employers. And that's turning regulation from a weapon into a framework. So no, this isn't speculation about what might happen in November. This is the post-election shift playing out in real time. And if you're not factoring that into how you position, you're missing the biggest non-market signal of the cycle. So what should you actually do with all this? First, keep an eye out on staking-enabled ETF filings. If any ETH products that include yield get approved this summer, that's your signal that the narrative is going mainstream. Tools like the SEC's Edgar database or platforms like Bloomberg are where these filings show up first. and they move markets quietly before Twitter catches on. Second, watch for custodial staking rollouts. If Coinbase, Anchorage, or other regulated custodians start offering staking yield to clients, that's not a maybe. That's the market flipping the switch. Especially if those services are quietly marketed to family offices or institutional desks that aren't loud on social media. Third, look beyond just ETH and Solana. Yes, they are the primary beneficiaries, but there is a second layer. Protocols like EigenLayer, which enable restaking and modular yield opportunities, or custody infrastructure players that power staking access for funds. These are the kinds of assets that benefit first when institutions want exposure without directly managing wallets or validators. And finally, track who's building, not just who's tweeting. Look for updates from Franklin Templeton, Fidelity, or smaller funds with strong TradFi roots. If they're hiring staking teams or integrating new partners, that's your tell. This isn't about chasing hype. It's about watching for structural shifts in how crypto fits into real portfolios. And right now, we're watching that shift unfold, quietly, but with serious money behind it. This week wasn't about price action, it was about positioning. While everyone else is still staring at the charts, institutions just got the green light to stake crypto legally. The Clarity Act is in motion, the SEC is softening its stance, and for the first time in a long time, US regulation is starting to work with the market instead of against it. You don't have to be a lawyer to understand what this means. Yield is coming to the mainstream, ETFs are about to evolve, and the assets that benefit most are the ones that already have real staking demand and institutional interest behind them. The key now is how you respond. Do you wait for headlines and retail hype to catch up, or do you use this moment to get ahead while things are still relatively quiet? Let me know down in the comments. What's your game plan now that staking is going institutional? Are you repositioning? Watching from the sidelines? I'd love to hear how you're thinking about this shift. If you found this breakdown helpful, make sure to subscribe and hit the bell so you don't miss future crypto updates. Thanks for watching, and I'll see you in the next one.